Welcome to another edition of the Southbank Investment Bulletin. So I thought I'd kick off with artificial intelligence, and Nvidia is accelerating higher. It's right in the region of the peak from late in 2021, and this is pricing in an awful lot of good news. But I think there's a graphic way of illustrating just how much good news is being priced in. That's the price to sales ratio. Now, it's a very simple way of looking at markets. You take the price, you divide it by how much the company is actually selling, and then it's very simple. It just looks at how many years it would take for the sales of the company to reach the price. And for Nvidia, that number is 29 years. So we're right in the region of this peak from back in 2021. Now, don't forget that back in 2021, interest rates were practically zero, and now they're in excess of 5%. And this valuation is well in excess where the market peaked back in 2000. Of course, nobody really cared about graphics cards back then. So let's look at instead at one of the darlings of the big market move in 2000. So Cisco got to a price to sales ratio of 60. Now that would be a doubling in the share price of Nvidia to get to that kind of valuation. It's also worth considering that 23 years on, it's at 3.6, which is hardly demanding. So we know that a lot of bullish activity is getting priced in here, and there's equal measures of enthusiasm and fear around the prospects for what artificial intelligence might deliver. But I think it's worth considering that bond yields are still rising. Now, one thing that I think is most particularly relevant here is that the bond yield peaked in late October of 2022, and it's really been going down since then. So that's been a support for stocks, and this is not a coincidence. If we look at the S&P 500, then it bottomed in early October. So in fact, it bottomed about 2 weeks before bond yields peaked, and it's still moving higher. So we're seeing that bond yields are starting to push higher from here. Now, there's a reason why bond yields are moving higher, and it's because the negotiations about the debt ceiling in the USA are improving, and it's likely, at least, that a deal will be on the floor of Congress next week. And the first thing that the US government is going to do as soon as that's approved is borrow a ton of money, and they're going to at least issue about $1 trillion worth of debt in the hours after a deal is approved. So that's going to siphon liquidity out of the market. It's certainly helping to push yields higher because all that additional borrowing is going to increase the supply of bonds. It is helping to support the dollar. Higher yields are making the dollar more attractive. It also means that interest rates are probably going to stay higher for longer. And then, of course, when you look at a highly speculative sector like artificial intelligence, well, those valuations are very aggressive. But one statistic I saw in here today was an institutional report talking about the potential for Google, for example, to implement artificial intelligence queries on google.com for the search engine. And the estimate of what it would cost in terms of computing power was somewhere between $30 and $100 billion a year. Well, that's why Nvidia's share is rallying here. And there's no sign that it's over yet, but it could end any day because the valuation is so exceptionally high. And we definitely have rising interest rates. Now, something that I think is very interesting is if we look at those valuations. And the valuation that we have on the USA right now is not just high, it's pretty close to the upper side of the historic range. So there are very few occasions on which the PE on the US market has been this high. And then we go to the other end of the spectrum, and valuations for the UK are at the lower side of the historic range. So then let's just look at what does the UK market look like. So the FTSE 100 is, in dollar terms, at the upper side of its range. In local currency terms, it's at the upper side of a much lengthier range. So then it does, of course, raise the question, when are those better valuations in the UK going to be attractive enough to encourage inward investment? Well, on a constant currency basis, it would certainly help if the FTSE were breaking on the upside. And if we see it pushing up through the 8,000 level, that's going to start to encourage inward investment from overseas. And the valuation on the FTSE 100 is not quite in single digits, but it's certainly more attractive than we have, for example, in the USA. Now, one thing that I think is also rather relevant is that the UK is plotting a bit of a middle ground. I do apologize that this screen isn't loading faster. I'm going to try it again on a different one, and then there we go, we'll see how that works. So the forward PE for the FTSE is about 11.5. Now, we definitely have emerging market valuations that are getting much more attractive. And the Brazilian market is down to a PE of 6.7, and it has a yield of 6.71. But one of the reasons why that valuation is so low is because the interest rate environment there has been so much more aggressive. So they have been raising rates up into the 13 levels. So short-term interest rates are around 13. And then inflationary pressures are starting to come back down. And I do think that Brazil is a very good example of what we can anticipate seeing elsewhere. That they were aggressively raising interest rates to get inflation under control. Now what's happening in Brazil is the central bank has said they're not going to cut interest rates, even though inflation has come back down, because they're worried about it coming back again. And they're insisting that the government put some fiscal constraints in play so that inflation won't get out of control when they start cutting rates. So that a similar type of thing happened in the UK. It wasn't specifically the central bank telling the government. It was the bond market telling the government that profligate spending wasn't going to work, and that the bond market imposed fiscal constraints upon the UK government. Now, we have not yet seen this happening in the USA, but bond yields are moving higher. And eventually that is going to have an impact on the cost of servicing the debt. And eventually there will have to be some kind of spending restraint imposed upon the USA. But until that happens, then it is likely that they will continue to spend. Now, gold prices are starting to roll over, and they've broken down to a new reaction low. And that's in response to the somewhat stronger dollar because yields are higher. But like I said, I don't believe that that condition is going to last indefinitely. One thing that I think is most particularly relevant right now is that US consumers are starting to pull back on spending. So Target, which is a very large retailer, and it would be like a Tesco that focuses more on clothing than food, but has both. And it's right back on the region of its lows. Then Walmart just came through with their earnings as well. And they've basically said that they had a very good January, and spending from consumers has been rolling over in in February and March. So the US consumer does look like there's some stress. And I think this is a very risky environment, but momentum is still driving a lot of interest in artificial intelligence. And it doesn't do anything to absolve the market from the risk of a recession, I think, later this year. And I think with that, I will leave you for today, and I'll wish all the best to all of you.